Ladies and gentlemen, we have a Bundesbank-sponsored research project which looks into Brexit-related capital market effects, basically in EU 27 countries, but of course also in the UK. And it is really interesting which key results we have obtained. Some of the key results refer to risk premiums in corporate bond markets in the UK and in the euro area. We make a distinction between financials and non-financial sectors, and this paper by Kadiric and Korus is really quite interesting, the empirical findings for various maturities. Basically, one can say the message of the empirical study is that the risk premiums in the UK increase, particularly the long-run risk premiums, a little bit less so in the euro area, and of course, not surprisingly, the highest effect, the strongest effect, the highest significance is found for the financials in the UK. There are other papers, including a paper of Mr. Bayer, one of our researchers here at the European Institute for International Economic Relations, and myself, where we look in foreign direct investment dynamics. So we look at a gravity model and we try to find out, okay, what is the effect of EU membership on foreign direct investment inflows in industrialized countries, and what we see then as a result, which actually is also somewhat in line with other papers, for instance, from the LSE, we find that the effect clearly is negative. We then ask also what could the UK do to compensate for this negative reaction of foreign investors. And based on the gravity equation, which includes the corporate tax rate, we can then show a table how strong the corporate tax rate in the UK would have to fall to compensate for Brexit. And the message is basically here that the UK government might have to consider strong corporate tax rate reductions, and I may add also deregulation of financial markets in order to attract higher FDI inflows and to achieve higher economic growth. So to offset the growth dampening effect of Brexit. So that would be a reaction of the UK government, which of course could lead to some political tensions with the EU 27. One may hope that the UK and the EU 27 post-Brexit would of course also cooperate in many fields, but one should also try to anticipate, let's say, some of the key problems, and then of course one wants to find solutions. Another interesting result by Korus and Celebi, in their paper they focus on the effect of Brexit news. We can say positive Brexit news, which would say the news is more in favor or pointing to, let's say, a soft Brexit, and the negative Brexit news, which is pointing more to a hard Brexit event. And what the paper then shows is that the negative news bring a pound devaluation, while the positive news bring an appreciation. There is a certain asymmetry, so the depreciation is much stronger than the appreciation effect. And there are many other aspects in the paper. And it's also very important that we have an additional FDI paper which basically looks in the foreign asset positions of British banks, so how are they influenced by Brexit, and we look there both at the banking sector and at the non-banking sector. So this is a Bayer-Welfens paper, Finally, I have also a paper which looks more into some of the theoretical aspects, and again also into the welfare aspects of Brexit, including aspects related to the demand for money. So I think we should expect from Brexit, okay, there is then reduced output growth, so this will weaken the demand for money, and therefore there is a welfare loss here. There will also be a welfare loss in the context of a weakened role of the British pound as an international reserve currency. And of course, one has to consider the aspect that the interest elasticity in the demand for money in the UK is likely to differ once we have Brexit, if you compare this to the single market situation before. Annie Molyneux from the University of Birmingham has contributed a paper, and there is also a forum where we are quite happy to have several contributions. And there is a paper on a DSGE model by Jürgen Jäger and Jenny Körner. Very interesting to look at this in the context of Brexit. And finally, there is an additional paper which we have included, which nicely fits into the overall range of questions. And this paper is from Barry Eichengreen from the University of California. He basically looks into portfolio aspects of Brexit and also raises the question how Brexit affects the institutional setting of the Western world, of the Bretton Woods II institutions to some extent. So I think this will be a very interesting special issue which you can find. So this is International Economics and Economic Policy, will be published in early March 2019, except for the Welfens Bayer paper, which already is available in public access in a different journal. And there is one more paper where Tian Xiong and then also Kadiric, Koros, and myself, where we are looking into some additional aspects of Brexit. So I think the historical challenge of Brexit is big. It's quite interesting. It's wonderful that we as researchers could contribute to the debate. We would hope that our research helps to find adjustment trajectories which minimize welfare costs, that we also should better understand the cost and risk of Brexit, and again, then policymakers have to draw their own conclusions. So the interested viewers can take a look also at our website, where you find the monitoring page on Brexit. And this is a process for many more years to come, and we and our research network, we will contribute to the analysis of this process.